I'd like to welcome all of our participants to our September webinar, Loan Monitoring Approaches for Performing versus Problem Loans, presented by Donna Nails. My name is Jessica Alfaro, and I'm so pleased to have met many of you at some of our forums and events, and the rest of you today on this webinar. I'm a manager at CapPlus Exchange, and I'm happy to answer any of your questions throughout the session or after the session as well. I'd like to thank all of you for joining us. A bit about Donna, and she'll provide a bit more information about herself as well. Ms. Nails is an independent consultant specializing in domestic and international development finance, as well as a senior banker with CapPlus Exchange. She is regularly called on to conduct operational and financial audits for international finance companies and to structure and recommend risk management practices. She has also served as the Deputy Director of Corporate Risk Management at the Shore Bank Corporation from 2003 to 2005 and spent 2 years in the Business Banking Department of Shore Bank in Chicago as a commercial lender. Prior to working at Shore Bank, Ms. Nails worked over 4 years as an international economic development specialist. Her specific experience includes overseeing a budget for SME projects in Ukraine, Moldova, and Belarus.
Thank you, Jessica. Thank you for that bio. It sounds much more very formal than I am. But I really want to stress a couple of things. That my background is in risk management, but it's also in lending. I work a lot in micro and SME lending, and I was a small business lender. That's what we called ourselves. We called them commercial lenders at Shore Bank, but actually I was a small business lender. So a lot of my experience and things we're going to discuss today are from when I was a lender, when I was in risk management, and also my work I've done overseas, working in many countries. I'm currently based in Bosnia, Herzegovina, and living in Sarajevo, and we will start. What we will cover today. What we're going to talk about is monitoring of performing and problem loans. And I think this topic does not get enough discussion, and this is why when Jessica came to me, it was the first topic I wanted to talk about. In the life of a loan, let's think about it. We have when you meet the client, getting the information from the client to complete your underwriting analysis, then presenting it to a committee, getting approval, and then disbursement. How long does that take? A couple of months. But the tail end of the life, or not even the tail, most of the life of the loan, 12 months, let's say 24 months, 36 months, 5 years, is when the loan is being paid back and when we should do monitoring. And we forget about it. I think as an institution, management and loan officers and forget about it. So that's why I wanted to talk about it today. Can you tell I'm passionate about this discussion? So I want to talk about why monitoring, what to monitor, when to monitor, how to monitor, and also one other thing is identifying yellow and red flags. I think many of us have heard about red flags, you know, the big warning signs that something is a problem with a loan or with a borrower or with a client. However, sometimes we forget to teach loan officers or to discuss yellow flags, something that doesn't seem right that could become a problem that we should know about. So I developed these slides for us to have to present and hopefully have a short discussion at the end. But I also wanted to be able to give you some slides and maybe share with your loan officers or your monitoring officers in the future. And of course, at the end, if you want any more information about any topic, you can contact Jessica and she would forward it to me and I can provide more information. So let's start. Okay. So I have a poll question here. Why do staff monitor performing loans, if they do? A, their manager tells them to monitor. B, it's stated in the loan policy procedures that a loan officer must monitor a loan. C, it is a proactive risk management practice to monitor. And now I'll turn this over to Jessica.
Great. So we're going to open up the first poll, and I'm already seeing answers come in. This is great. So you can vote for one of these. and Donna will give us a little bit of background on which is the right answer and why. So we'll keep this open for about 30 more seconds. So why do staff monitor performing loans? Is it that their manager tells them to, because it's stated in the loan policy, or because it's a proactive risk management practice? So let's keep it open for about 10 more seconds here. We're getting in quite a lot of answers, so thanks everybody for participating. We'll leave it open for about 5 more seconds, so please get in your final votes if you haven't already. Excellent, and we can go ahead and close the poll. And Donna, overwhelmingly, 73% said that it is a proactive risk management practice to monitor. About 18% chose the second one. It's stated in the loan policy, and about 9% told them that their manager said that their manager tells them to monitor. So Donna, I'll turn it back over to you.
Okay. Well, you should, for people who said C, that is fantastic. That is what I would like to hear from loan officers, what they should do, because they think it's a proactive risk management tool. Obviously, you all do. However, I'm going to be honest. Many loan officers, because I was a loan officer, did it because my manager told me to do it. That we had monitoring reports that we were supposed to do for certain clients over a certain loan size. And so it was stated in the loan policy, so we had to do it. So I like that you said proactive risk management practice to monitor. Yes, that's correct. But in reality, I would say a lot of loan officers get caught up in disbursement and not in monitoring, and they just do it because we tell them to do or that it's in the policy. So that's just what I wanted to talk. But thank you for that poll. And please congratulate yourself, because I think you gave me the right answers, all of you. So now I have a story. The case of the bad loan officer. A true story, a very true story. So there was this loan officer, someone I knew, who had a daycare client, a daycare that watched, like a kindergarten, watching children, okay, small children under 5 years old, who got a loan from a financial institution to purchase a business premises for the daycare about 2 kilometers from the loan officer's home. So not far, very close, okay? The loan officer knew the client's cash flow was tight. You know, during the financial analysis, the client could pay for the loan for the business premises, but it was tight. It was really tight. So the loan officer didn't monitor the client, though. Didn't go visit the client. Why? The client was paying on time. So client paid every month, sometimes early. So that's a relief, right? Case of the bad loan officer continues. One day, the loan officer drove by the daycare and saw the part of the roof of the daycare center had fallen in. Literally had fallen in. That's the loan officer running across the street after she parked her car to go see what happened and who was in the daycare center. So case of the bad loan officer continues. The loan officer was me. This is an absolutely true story. I was driving my car past the daycare center, saw a big sheet over the top of the roof, saw that something was up with the roof, quickly parked my car, ran across a highway to look in and see no children, an empty premises, and part of the roof fallen in. I immediately called the client, and she said the roof had fallen in 3 months prior. Okay, I think she had had this loan maybe about 6 months at that time. She was making loan payments. I said, how are you making the loan payments? You have no income. She said, I'm making the loan income because I'm borrowing from somebody I know. This is worrisome. Who's this person she's borrowing the money from? How much does she owe them? And she said, she did not know when she'd be able to repair the roof. She didn't have any income. That's me. Really, putting my head out, just unbelievable, going, oh my God, what is happening? So, what are the lessons I learned? And I'll tell you the end of the story, but let me tell you the lessons I learned, and this is when I was, let's call me a bad loan officer, junior loan officer. I should have known there was yellow flags when I was dispersing this loan. She was an inexperienced business person. She was good at doing her daycare and organizing that with the children, but she wasn't a financial person. So she wasn't the business side of that business, or the financial side of that business, I should say. And as I noticed before, her cash flow was tight. I knew every month that she wasn't putting a lot of money away. If anything, she wasn't saving because it was very tight. So if there was something that happened, I knew that she didn't have the money. But she paid on time, even though she was only 2 kilometers from my house. I didn't go see her. So I should not have taken comfort in the client making the payments when there was yellow flags. Monitoring, what I learned, monitoring could have been a phone call because the client immediately picked up my phone call and told me exactly what happened. She wasn't hiding anything from me, which was interesting to me. She didn't hide anything from me. She just hadn't thought of calling me. She just went and borrowed the money from somewhere else to pay me. So what happened with the daycare? She struggled. She kept taking money from another person. And finally, my bank could not give her any more money, and she went to another financial institution that gave her more money. What I heard, she survived. It was very difficult for her, and the person that was getting money actually became a partner in the business, took over part of the business from her, which was what I would worry about, was who was this person that was giving her money, and was the ownership going to change in the future? Because I had given my money to her. I didn't want my money going for a business that was owned by somebody else. So that's what I learned. So why monitor? And this is something I think we need to talk to loan officers about. In fact, I'm going to be honest, I do trainings for these 1-day, 2-day trainings, 3 days on how to monitor the loan officers. Not only good clients, not only bad clients who aren't performing, but what good clients too. It's a skill we need to teach our loan officers. So, like I said, loan officers sometimes are only monitoring when required by management. We need to teach the loan officers that just like underwriting, this is a risk management tool. They understand, loan officers understand why they underwrite a loan, why they have to prove that we have sufficient cash flow, but they need to understand that they're a risk manager and it continues during the life of the loan. Continues. We need to teach staff to identify yellow and red flags. I think they get the red flags. I think many loan officers understand the red flags. Sometimes they see the yellow flags, but they don't know what to do. The worst thing, what I really don't like, is surprises. So our goal with monitoring is no surprises, and that's what I always tell my loan officers when I'm working with them, is when you see something that doesn't look right, that doesn't feel right, something with a client, then you should not tell me or monitor the client to make sure that it doesn't happen, or that it doesn't turn into a red flag or a non-payment. That's the thing, right? No surprises. Don't tell me you knew something months ago and that it didn't seem right, and then something happens. So one question I always get is, how often should a performing client be monitored? And that is very hard, difficult question, because in the perfect world, every client would be monitored on a monthly basis, right? If I said that to my loan officers and to my head of credit, head of lending, they would probably just be so upset with me because they don't have time, right? We have to be efficient. We have to disperse. That is one of our goals. So what I usually say is, usually larger loan size, usually a specific loan size, you might monitor maybe if it's a client that isn't well known, maybe quarterly. But new clients, maybe for the first couple months, they should be visited, or just even a quick phone call. How's it going? Thanks for making the loan payment on time, or even better, calling to say, oh, your loan payment's due in a few days, just thought of you and hope everything's going. So it doesn't, some institutions I've seen have very structured monitoring policies. If this client is rated this, or if this client is of this certain loan size, then it needs to be monitored monthly. I like that. However, I think we need to be realistic that every client can't be monitored every month. But some should. Let's be honest. There's some clients that struggle that a phone call every month just to make sure the loan payment's going to come in is the way to do it. So let's talk about questions to ask a performing client. So this is another skill we need to teach our loan officers. Because I, as a bad loan officer, I say bad, but I should say as a naive, new, junior loan officer, would go visit a performing client and not ask the right questions, or not ask any important questions. I would go see a client, and I'd be like, oh, yeah, how are you doing? They'd say, fine. I'd talk about the weather, maybe something else, and then I'd leave. And then I realized I hadn't asked them about the business, about cash flow. I hadn't asked anything. So we need to teach the loan officers just to ask a few questions. You start out the conversation, right? How's the business going? See if it's any issues. Everything been going fine? And then if you can, with the client, you can start talking to them. If they don't give you, we have clients that have financial statements, then we have our clients that don't have financial statements, right? Or they're very basic financial statements. We might ask them, how much do you sell a day? Okay? So you can, is that the average for this time of year? So we just need to kind of feel them out, I say, to make sure that there's money coming in and to understand this. Of course, on the other side, talk about expenses. Is everything normal? Have you had any unusual expenses? These are more questions when clients that don't have the audited or the more formal financial statements. For small businesses, even in America, this is true in the U.S., I found this true. For small businesses, family and businesses are mixed up, right? They're just so if something affects the family, it usually can affect the small business. So I would always ask, how's the family? And see how that is. Is there anything new to find out? Sometimes in some countries, as soon as the child got to a certain age and there was university, the schooling costs, things change, or a wedding. Many countries I've worked in, as soon as you know that someone is getting married in the family, a child, then you know where the cash is going. So that is always why I ask about how is the family. Again, that's usually for smaller loans. And then the last question, I always ask this question, has it been easy to make the loan payment? Especially for borrowers that are smaller and new, that they're new to a loan. They haven't had a loan before. So maybe they haven't, learned to budget and just figure it out. And it's interesting for me for clients who say, no, it has not been easy. But when I had looked at their financial analysis I completed earlier and saw, well, it showed that they should have a lot of extra cash at the end of the month, but they're telling me it's not easy to make the loan payment. What happened? What happened between my analysis and now in reality? Now, of course we know sometimes in analysis a cash flow is different than reality, but we don't want it to be too different. We don't want to be so different that they are hardly barely making the loan payment, right? So this is the last. Check the info against the budget or the cash flow that was developed during the analysis. I think it's always really important. Even for small clients, I won't take the loan file, but I'll write down what they said, what their revenue was going to be for that month, and also about what they said their expenses were going to be, and I just talk it through and I kind of cross-check the information. Because if it's not the same and it's drastically different, that's a yellow flag to me, that I need to monitor this and talk to them about that. And are they understanding they need to watch their budget, watch their money coming and going.
Donna, we
Okay.
actually have a question before we move into the poll. If we could go
Okay.
back to that slide. Um, and Grace, I'm going to read your question aloud here, but if I want to make sure I understand. So, is the assumption that the loan officer is fairly experienced to be factual? I think, or was it tactful or factual, Grace? But I think it's essentially, you know, are we believing that the loan officer is experienced to appreciate their analysis? You know, do we have to take that issue into account when we are looking at some of these loan monitoring and doing these questions?
So a realist that the original cash flow, was it actually realistic? Is that what you're
Right.
asking? Is that what?
Yes,
Yeah.
that and also kind of an issue. Can this loan officer ask these questions tactfully? So maybe some
Yeah.
ideas of how you
Yeah.
tactfully ask these questions.
Yeah. Yeah. You know, good questions, Grace. The cash flow is difficult. This will, I find cross-checking budgets with, or the financial analysis going out with loan officers. I'll actually go out and do it. It teaches them how to do that more realistically. I think many of us know there's loan officers that we've known that just kind of either listen to the client, write down the numbers, or actually, guesstimate with the borrower what the numbers are. And we've got to teach loan officers how to get a realistic understanding of what the actual cash flow is for a client. So yes, you're right. If the cash flow wasn't done correctly, the original analysis, looking at the budget is not good. But it's a good way to kind of talk with the client too, to bring up a discussion. Oh, you said that your revenue would be, 1,000, and you're saying it's 500. Just kind of wondering what's happening. And you're again, tactful is really important. This is why I recommend I do a lot of role plays with loan officers, just to kind of talk to them. You would go visit a client. Unfortunately, you would like to be able to do these discussions with a client 15 minutes, 20 minutes, so you can move on and do other businesses. Unfortunately, especially new clients, you got to take a little bit more time to talk with them and just say, how's everything going? That's why I think the way I even ask it here, like, how's the business going? Any issues? Everything going okay? I have a range of clients I visited. Some will literally, like, small stores have books, right, that they keep maybe how much they sell. Some clients have no problem. Like, I start asking them, how much you sell a day? They're like, oh, here, look, and they let me count it out. Others aren't as open or as transparent. So again, this is a skill we have to teach the loan officers. And in a casual way, we need to teach them how to get this information if the client seems, to teach them in a more tactful way. Thank you for the question. A very, very good one. But we have to teach them how to be tactful, I think. Because many times, and we have to teach them they can ask these questions. This is just as important. I have too many loan officers that tell me, oh, I can't, how do I ask? The clients get angry. The client should not be angry. You gave them a loan. I mean, I don't want to be tough, but we gave them a loan, so they should understand, I need to know this information to make sure everything goes as we agreed, because we have an agreement. You have an agreement with my financial institution. So you don't have to be nasty or mean about it, but they also have the right to ask these questions, and we should teach them that also. Okay, next poll question. In your experience, what is the yellow flag that indicates that a client may become a problem in the future? Okay, the client's paying now, but they buy a new car, the client does not return your phone calls, the client moves the business to a new location. So the business is still running, but they move it to a new location, or the client gets married.
Great. Thanks, Donna. So we'll open up this poll. We're getting quite a few responses already, and you can select one of these. So what is a yellow flag? So a client buys a new car, client does not return phone calls, client moves business to a new location, but it's still operating, or a client gets married. So we'll keep this poll open for about 10 more seconds. And thanks to everybody for responding, and we'll leave it open for about 5 more seconds. Okay, great. And David, we can go ahead and close the poll. Great. So we're seeing 58% of the participants state that if a client does not return a phone call, that's a yellow flag. 32% are saying if the client moves to a new location, and then 5% equally for buying a new car or getting married. So Don, I'll turn it back over to you.
Thank you, thank you. Well, there is no wrong answer. There we go. Because I've had, all these have been indicators to me that the client became a problem client, i.e. didn't pay. So I agree. I think the number one indication if they don't return your phone calls. I did have one client who had bought a pizza or was building a pizza parlor. He had one and he was starting another one. And I'll always remember calling him like he wasn't returning my phone calls and like leaving a message saying, please call me. We can talk. If there's a problem, let me know. And so this is why I always tell loan officers too, when you're working with a client, even when everything's going well, so always state to them, please let me know if you ever do have problems. Just let me know. Life happens and things happen. We need to be able to communicate and be. I always remember I had one client. He was good, long-term client of the bank, and I remember sitting in my office and watching him drive up in a new, very, very, very expensive car and thinking, oh my, and then thinking he's going to have problems. And guess what? A few months later, he needed some extra cash and he had his fancy new car, but he didn't have the cash. I think he sold the car pretty quickly, but I remember thinking he's going to have problems because I know all his savings just went in probably a loan, because I don't think he could afford this very expensive car. Went into this car. Client moved business to a new location. That's always an interesting indicator because especially if it's a service in, like a restaurant or a store, a new location means different foot traffic and also could be an indicator also. And D, client gets married or the children get married. Not that this is will make that it will become a problem loan, but this means their cash is going somewhere else. And I know that if they get married, or sometimes depending on the culture and who pays for either the daughter or the son, I can tell you where the money is going to go when there is a wedding, or that the money went to the wedding, depending on the culture. So all of these are yellow flags that mean something needs to happen. But when the client, you're right, when the client doesn't return the phone call, that's probably the biggest indicator that something is up and there's some issues going on. And with my client, to tell you the truth, when he didn't return my phone calls, I was not a good loan officer because I should have told my manager, because what happened was then the client all of a sudden became late. So he wasn't returning my phone calls for 2 weeks. Then the payment was due. He didn't pay. My manager who sat next to me said, what is up with this client? And he said, well, I said, well, he hasn't been returning my phone calls. He said, really? Well, that was probably an indicator that something else was going to call. Okay, next slide. So now we're going to talk briefly about identifying yellow or red flags. And we're going to talk about different types of monitoring, kind of monitoring or understanding yellow flags with the general environment, monitoring like from the office, monitoring during a site visit to the client to see the business, and monitoring the financial statements. Okay, general environment. These are yellow flags. Again, this doesn't mean the client's going to be late, but it could mean, especially to management, to think of at maybe a portion of your portfolio. One is market conditions or the economy. When we had the big downturn in our economy in 2008, 2009, small businesses, especially the service industry, restaurants and other types of service industry they were devastated. It was very hard. So we, in the financial institutions over there, were looking at our portfolio and calling our clients and talking to them about after, a few months, what was happening to their businesses, what was happening to their revenues, to kind of just feel it out and see, are we going to see a lot of non-payment in the future? You know, how is it going to be? Sector issues. There was a country I worked in where there was many stores that sold used clothing, right? Resale of clothing. And then a law was passed regarding some legislature about the actual licensing of these stores, which caused many problems in the sector. And the financial institution I worked with had provided financing to many of these little stores, and we knew as soon as this laws were being passed and this requirement to get some new kind of licensing, that our businesses were going to have problems, not just paying for the licensing but getting licensed. And so we started to have to look at how many of these businesses we had in our portfolio and start watching and meeting with these clients. New entrants to the market. I'll have an example of that, but this is a lot with small stores. We see in some of these economies I work that, you know, the small stores, as soon as maybe one of these big chain stores moves into the neighborhood, and these small stores are devastated. They aren't able to really, unless they have some kind of specialty, they're not able to compete. So a lot of times new entrant to the market is the marketplace or the area, the surrounding area where your client can be. Others. One is once I had some clients on a major street, but then the construction took very long time. There was flooding because of the construction of the street, and it was a restaurant, and it caused major problems in my client. I had to restructure the loan. They weren't able to pay for a number of months. That was one. So my example is my bank financed these donut stores called Dunkin' Donuts, which are very common in the U.S. I think there's some overseas. And we had financed a lot of these franchises. And then a new entrant, Krispy Kreme donut store, came to Chicago. And we were very concerned. Krispy Kreme was kind of the new, exciting donut. I know this sounds very silly, but it's very true. And so we were worried because they were starting to build these Krispy Kremes like literally across the street from my Dunkin' Donut store. We were very worried, but what we found, so we started monitoring all our Dunkin' Donuts, our franchises, and we found, though, that actually there was a slight, maybe 10% decrease in revenues for our stores, our donut stores, because it was a different type of client that was going to Krispy Kreme, because they were more expensive than my cheaper donuts, Dunkin' Donuts. But we had to monitor this because we really thought that there was going to be some problems and that they would eat into our donut store revenues. So that was kind of an interesting situation. Fast forward, Krispy Kreme as a corporation went through some financial problems, and a lot of them are gone, but the Dunkin' Donuts are still around. So red flags during a client visit. So the biggest one is a borrower's client. If they're like becoming unavailable during the visit, or they're not communicating, they're not answering your questions directly, they say they have to go. I mean, that's the biggest indicator. I had a situation where I visited a client, and the wife and the husband started fighting in front of me. It was a family-owned business, and a little later did I know there was a lot of stress going on between them because the business was not healthy. I went and told my manager, and he said, you know, let's go out and visit them again, because I said it was a very uncomfortable situation. He was able to tactfully ask the questions about the finances, and it was very obvious then that they were having financial situation and that there was problems with the loan. When you go and visit a business and it's closed during normal business hours, that's why I always like not only to let the client know that I'm visiting, but sometimes I'll just, if the business is close or I'm going to visit another client, I'll just stop by to see that it's the normal business, that it's just running during the normal business hours. No inventory, or inventory is old. This is very true of small stores, or when I go see manufacturers, I can tell, you know, are their shelves empty, or do they have a lot of product they're selling, because it can tell me if they got a lot of turnover, a lot of revenue coming in. For me, if a client gets a new car, new watch, that worries me, because that means they have no cash if they have a bad day. So that was, I wouldn't call that a red flag. That should be a yellow flag, maybe. And the loan officer should review those financial statements and underwriting analysis prior to a visit. As Grace said, maybe that a financial analysis isn't true or realistic, but loan officer, by talking and comparing, can tease out some things about how the client's doing going forward. So red flags in the office, what we can do from the office, okay? What they are, the client doesn't return the phone calls. We discussed this. Number one issue, right? The borrower's conduct on the phone, of course. If they're short, if they don't answer your questions, they're distracted, and they get off the phone quickly. Numerous overdrafts. So for banks that also have the accounts, the current accounts, can also see if there's overdrafts. And yes, clients may have, you know, a trend of like one overdraft every couple months, but of course you should be monitoring their accounts, and if you see an uptick, it should be a red flag that there's something happening if you see more overdrafts than the norm. If you're requiring financial statements, that's also can be an indicator if they're late. Covenant violations, so if there's some kind of covenants that they have to hold to, maybe for the financials, like a certain amount of cash or current ratio, if they're violating it. You know, past due, yes, that's a red flag. But many loan officers only begin to monitor when it's past due, and then it's actually too late. So that's why I'm saying this is really easy to monitor from the office. Very easy to call a client and just have a quick conversation. So let's talk about financial statement monitoring. So one question I'm actually, before I even start, it was going to be the end of the slide, but I'm going to start with it. Like, how often should we look at financial statements for our clients? Again, you know, we have different set of clients, right? We have our clients that actually do financial statements on a monthly basis and can provide them to us, or we have our very small clients that hardly do financial statements, might not even, they don't do financial statements, let's be quite honest. I had a bakery. She was a woman who owned a bakery. She was a fabulous baker. It was very, I could tell it was profitable, but she was horrible at finances. Didn't really think, she only knew kind of how much money she had at the end of the month, but really didn't know revenues or expenses. So what I did for her, I made up a sheet that had revenues, expenses, and cash at the end of the month, and I handed it to her because it was a cash business, right? And I said, I gave her 12 of these, and I said, every month I want you to fill this out at the end of the month, and I want you to fax this in to me or send it to me, because I wanted her to start thinking about it. I also would monitor it to see if there was any trends or any differences. So larger clients who do financial statements, yes, we'd like to see them. For big clients that are a substantial loan amount, yes, we probably want to see it monthly. But maybe quarterly, or have them at least fill something out. And, you know, for clients you're worried or you're trying to train them, we have to train our clients sometimes to think about, they might be a good business person in what they do, like baking, but we'd have to train, I had to train her to think about revenues and expenses. So what do we look at financial statements if we get them? Cash, you know, do they have cash? No, where is it going? Now, some places, in some countries, you can't tell where the cash is. Clients will not keep it at the banks. They keep it in cash somewhere. So that's something that you have to, you know, we have to tailor to a culture. Account payables, receivables, we need to note if there's any changes in amounts. Inventory, is it growing? You know, do you see it changing, or is it just growing, growing, growing? You look at current accounts. If you have access, does it match up the amount of money coming in? Is the revenues coming through current accounts? Again, some businesses I worked with in some countries, the clients would not put their revenues, they didn't put their money through the bank. Compare the statements again to what the client said before disbursement, and look at trends. You know, too many times a loan officer would only look at that financial statement or that financial information at that point in time, but doesn't look what was last month or the month before. And we need to kind of think about it as a continuum, that you have to look at trends. You can't just look at 1 month. It doesn't tell me. I need to compare to the month before. Has cash gone up or down from the month before, or from 2 months before? So that's also very important. And then something was always interesting to me when I work with loan officers. They look at a financial statement and they come to me and they're like, oh yeah, cash is down, looks like inventory's up. And I'm like, why? And they say, I don't know. I said, well, then call the client. I said, if you see something, just call, and in a nice way, you got to ask about these interesting trends or discrepancies and make the client explain. Again, you have a contract with them. The financial institution has a contract. We gave them money. They need to pay us back, and also be transparent and open about what's happening with the business. So we should never be afraid to call, but maybe we need to learn how to ask these questions tactfully, right? But we should never, ever be afraid to ask a question to a client. I think I talked about how often we should get financial statements. So one other interesting monitoring item that I used to do as a loan officer, and I've implemented at a number of financial institutions, is annual reviews for performing borrowers. So this is more, let me explain what it is. In many financial institutions, we require an annual review for loans over a certain size or risk rating, meaning if it's a larger loan, or maybe if it's risk rated, maybe on the watch list. Depending on how your risk ratings are handled at your financial institution. So this would be like kind of a little bit a formal review based on updated financial statements, similar to a credit proposal, but it's not a full credit proposal. It's just updating the information. And it's submitted through formal channels, meaning I would have to do this for my larger clients, right? I would get updated financials, usually there was a schedule. So usually when most of my clients, their financial statements were due, completed 12/31. Even if they were just compiled, I'm not saying formal audited financial statements, they would do some kind of financial statement. And they would provide it to me, and then within a few months, I would require them to send it to me within a month or two, and then by March, the end of March, I would do my annual reviews, and I would have to hand it to my boss, who would then review it and make notes or comments or ask me to follow up if there are any items, and then they would go into the the file of the client. So then next year, when I had to do an annual review, because I had to do them every year, I could look back and see what I wrote and see if there's any changes. So I want to talk about, this is really important, about understanding categorizing clients, and especially for monitoring, because sometimes when you're monitoring a non-performing client, like somebody who's late, loan officers can waste a lot of time working with clients who really don't want to pay. I did this. I remember talking to my team leader and saying, oh, the client said he was going to pay and that he had this happened, and my team leader would say, that's what they said 2 weeks ago. He hasn't paid. We've given him 2-3 weeks. Now we need to send a default letter. So this is I made this chart, categorizing clients. So we have our clients who pay and do pay. These are hopefully 99.9% of our portfolio are our angels who just pay on time. Okay, we have our can't pay for want to pay. So these are clients that maybe have had some problems with the business, the cash flow is tightened, or it slowed down, or they had something that was a roof fall in, but they want to pay. Okay, so they want to work with you. So a client, maybe these are clients that a loan officer keeps trying to work with, maybe even thinks about restructuring. Okay, so these are clients, I wouldn't call them angels, but they're trying to be angels. Now we have our clients that can pay, so they have cash, but they won't pay. So this is a character issue, right? These are little devils, I call them. And so the problem is recognizing, having loan officers understand who can pay but won't, and who can't pay but wants to. Because these devils, a lot of times, will only be pushed sometimes if you work on sending a default letter, or the legal process, or if you get somebody other than the loan officer involved. So this should be streamlined, or more. So after if you can figure out the client has money, he's just not wanting to pay, then maybe the boss, your manager, gets involved, and you send your default letter more quickly if you can to push them. The last one is you can't pay and won't pay. Well, these guys, unfortunately, is normally have to go after collateral or guarantees because they don't have the cash flow. They're not even trying to work with you, or maybe they just can't work with you. And these are the ones that you just have to move quickly through the system. So questions for problem clients. This is another important tool to teach your loan officers. So to think about these questions and get the answers. What is the cause of the client's problems? Is the cause that the client like had something like the roof fall in or something that they had to repair, so it was a one-time expense? Or is the cause because the client is like I had a client, I couldn't figure out where the money was going, and finally I found out through some channels had a gambling problem. So the cash that should have been paying me was going for gambling. Now that's a whole nother story. But finding out what the cause of the client's problem, and if there's cash, where is it going? So this is another one. In small businesses and medium-sized businesses, entrepreneurs love to start businesses. So I tell you, around the world, everywhere, an entrepreneur will have one business and it gets going and it's going fine, and guess what? They get a little bit of extra money and they start another business. And many times I find my money that should be paying my loan, when it starts, let's say the loan payment starts getting paid slow, like a little bit late every time, I find out there's another business that started. So there is very tight cash flow, these entrepreneurs. So that's one thing I've learned about entrepreneurs around the world. They want to start businesses, get a little bit extra money, they want to start 2, 3, 4 businesses. How's the client going to solve these problems if there's slow payment? Like, that's another thing is, you have to have loan officers think about answering this question. Is a client willingness to cooperate? So this is, remember, can't pay but won't. So won't cooperate or will cooperate? That's a very important question, because that we can be more patient maybe with clients that are willing to cooperate, a little bit more patient, that maybe are trying to work to be able to solve the problems. Can the client bring payments up to date? That's an important question I always ask my loan officers when they go visit a problem client. When are they going to bring it up to date? When? That's the most important. And the strengths and weaknesses of the financial institution's position. This is, it's different from country to country. I just worked in a country that the legal system was so swift and effective that, boom, 60 days, they're not paying, default letter, and believe me, like as soon as that default letter comes, then the courts are there, the bailiff is there, and within, you get a high percentage of people paying between 60 and 90 because the courts are there and effective. Other places, it's a slow process that even going to the court process, we know 2 to 3 years, and to get collateral. So you need to understand, of course, all of you understand the strengths and weaknesses of your financial institution. And other debts incurred by the borrower. This is one of my #1 questions. Where's the money going? Then I always ask, have you gotten any other loans? From anybody, from family members, from other financial institutions. That's another question, because I always find my borrowers tight cash flow, they go and get more money. Or they're entrepreneurs and they want to start a new business, so they get another loan. Okay? So those are some of the questions I ask problem clients. Problem loan report. So when you have a problem loan, and we're talking this is a loan that's over 1 payment late, 2 payment late, maybe 3 payments late, you should do a special report. So just quickly, it should include some loan data, including collateral position. It should state the reason the client's not paying. Document historical discussions with the client. Okay, you should keep all the discussions. So when I look at one of these problem loan reports, I want to see what the client said 2 months ago and what the client is saying this month and last month. Is he or she changing their story? They said they were going to sell a piece of equipment to pay us. Now, did they do that? Why didn't they do that? They said they'd sell it 3 months ago. So I just don't want to see the discussion now, because that will tell me about the character of a client and what their willingness to pay and their ability to pay. I want an action plan. I want to know what the next steps are. I want a deadline for the action. Like if they're going to give me a partial payment, tell me the date they're going to pay, because then I know if they don't pay, I need to follow up. And everything should be updated on a monthly basis for management to review and say, okay, this sounds good. In my financial institution, I would update this, and sometimes I'd give it to my management, and they said, okay, now it's time to move to a different level. We're handing this loan over to we had problem loan management department. Usually after 60, 90 days, sometimes I can keep it longer, but that management would read my report, talk with me, and say, okay, you have tried everything. This client obviously doesn't want to pay us. Move it to another department to be handled. So common mistakes, monitoring, we know these. It's only done when the client is 25 days late because myself, it only affected my bonus when it was 30 days late. So, I'd listen to these clients and I'd call them maybe, or they would email me, say, oh, yeah, I'll pay you, after 15 days. And then at 25 days, I got nervous because it affects my bonus, and then I would start monitoring. But I should have been monitoring and visiting the client earlier. Loan officer does not know what to do or when to look for when they're monitoring, both performing and non-performing clients. Loan officer doesn't review any information prior to visiting the client of the information that was in the analysis. Observations are not documented, so there's no report. You go and visit a client, and then that's it. Nothing is documented. No one even knows that you went and saw the client. There's no proper way of handling observations from the visit, meaning if the loan officer also has to feel comfortable going to management and saying, I saw this, the client was nervous, like I did. I went to my team leader and said, the client started fighting with his wife, and they started yelling, and I just left. I was uncomfortable, and my team leader said, we need to go visit that client. Let's find out what's happening. No proper filing system of monitoring reports. So there should be a way, and I'll talk about this, maybe in an MIS system is the best that somebody can write in, or it should go into a loan file. It should go somewhere where it's documented. And then the monitoring results are not tracked or analyzed by management. That no one looks at when your loan officers go to monitoring, no one in the management is even looking at this. Okay, so in summary, again, I don't think I probably said anything you don't know. Hopefully I said one or two things that you haven't thought about, but many of you are very experienced. You know this. I just want to summarize this. And again, these are things we got to remind all our loan officers and teach them these skills. So in summary, you have to teach loan officers how to monitor, provide training, including case studies, right? And role plays. Teach them how to ask the questions in a tactful way. Support proactive monitoring. Give our loan officers enough time to monitor and make it a priority. And require monitoring, including phone calls, to be documented, preferably in MIS, or just develop some simple document for the loan officer to complete, or something, a piece of paper in the file. And that's it. And I will turn this back to Jessica.
Great. Thank you so much, Donna. This was very, very helpful and I think timely for everyone. We are taking questions now, so please post your question so I know that you do have a question or comment for Donna. And if you have a microphone, I would be happy to unmute you for this. And Natalia, if you don't mind, I'm going to unmute you if this works, and you can ask your question directly. We'll see if this works okay. Natalia, are you there?
Yes, I'm here. Can you hear me?
Yes, I can. Could you tell us which organization or which country you're calling from, and then feel free to ask your question directly to Donna.
Well, thank you so much. I'm from USAID Regional Mission to Ukraine, Moldova, and Belarus, so I think we crossed paths with Donna Nails because the name is really familiar. We could have worked together. And I'm here with my colleague Irina Galenka from Office of Financial Management, and I'm from Office of Economic Growth. So we do have financial sector programs, and definitely we work with banks, and we have portfolio guarantees covering credit unions loans or bank loans. So we also need to understand on our side how it works and whether the bank is doing the right thing, the kind of all that they can do to monitor properly loans. So this was extremely useful. We took a lot of notes, and we already see how this could be applied to our own monitoring of project implementation of our partners, new and current. So my question is, those are great questions, but at one point you ask all these questions and suddenly the person becomes unfriendly or becomes aggressive, and he can basically tell you, mind your own business while I do mine, meaning that you go to the bank, let me work, and then I'll get back to you. You ask when, and the client says, I'll get back to you. And you say, when? And the client just says, I'll get back to you. So what would you do?
Natalia, I actually worked thank you for the question. I actually worked at USAID in Kiev from 1998 to 2000, so probably our paths did cross. So that's a really, this has happened, you know, around the world, that clients get that they, you either, you know, this could be a couple things. It could be just their demeanor. They could have been maybe even during the analysis stage when you're asking questions, they did not like you asking questions. But, you know, hopefully experienced loan officers, and I got better at this as I got more experience, will be able to explain to a client, you know, we monitor our good and our performing clients, and we need to get this information because we are required by our policies to understand what's happening with our clients and report up to management. Unfortunately, if you don't, you know, I understand you're busy, you can't provide the information now, but we need to get it later, so then it doesn't become a red flag to my management. And you know what? You may just have clients that are continually aggressive and unfriendly. And if it's a large client, then you have to bring management in to help monitor. If it's a smaller client and it's only a small few of these clients that do this, then you know, then you have to you can maybe deal with it and try to get a little bit of information, or at least note the business is operating, notice a lot of clients coming in and out, and maybe you can get comfortable that the business is performing and doing well without having to ask the questions to somebody who is not a very friendly person. But if this person was friendly during the analysis stage and now they're unfriendly, that would make me wonder. That with the wife and the husband that were fighting, I told you, they were he was very friendly when I was giving him the loan, and then after the loan, that's when they were tense and unfriendly and didn't like my questions. And it was like I said, it ended up being they had major financial problems, and it only came out because of their personality. So that's, I guess, something a loan officer will understand. Was this always a person that was unfriendly? There are unfriendly people in this world, or is this somebody that demeanor changed after I gave them the loan? You know, that would be a warning sign to me. Thank you for the question.
Thank you.
Thanks, Natalia. So we do have a couple other questions coming in, and please continue to post your questions here in the question box. And Donna, we did have a question sort of towards the end of your presentation. You were talking about documenting loan monitoring. So maybe you can delve a little deeper into that. Tell us more about, you know, best practices for loan monitoring, and then also share what are some of the best practices for roles of the management versus the loan officer. You know, if the loan officer of the RM, the relationship manager, is actually doing the monitoring, what needs to take place from the management perspective? What's their role?
Okay, so documentation, you know, in a perfect world, in my little risk management world, everybody would fill out one full sheet or half sheet of how the monitoring visit went. Now, that's not realistic. Loan officers, and believe me, I did not do that as a loan officer. I didn't have time always to document it. I've seen good systems, though, in an MIS that the loan officer can come and quickly open up a box, say, I saw the client is performing, financials seem fine, you know, and can make a few notes in the MIS. I've seen paper reports have to be completed where they can make a few notes on, you know, verify that client has extra cash flow for small loans, and it depends on the loan size. With a larger loans that, you know, are more risk to your financial institution, you want better documentation of the monitoring. If it's a smaller loan, then maybe just a sheet in the file where you can say, I visited client, business is operating, all seems fine, discuss financials, and so a few lines. Again, you know, there is our dream documentation, shall I say, for a risk manager is, you know, full page on every client and every business. And then there's the realistic of, you know, how can we do this in an efficient way where we can get the information done. The best financial institutions I've seen have always put in MIS systems. I've seen really good MIS systems. And then you said management role. Now, this is interesting. Management role should be making sure that loan officers are doing monitoring, A. And then second should be also going out with the loan officer when needed to make sure that on larger clients and also with more riskier clients or some clients that have become problems, that they can help and assist the loan officer. You know what? The other thing I should say is also management. Somebody should go out with newer loan officers for a few visits, few monitoring. Teach them, as you know, show them how to ask the questions in a tactful way and how you work with a client. That's how you should also do it. Jessica, any more questions?
Yes, very helpful. So we have a specific question from one of our bankers in Malawi, who unfortunately does not have a microphone, but she wanted to share an example and ask, you know, how to monitor or improve upon, you know, a situation where the customer is derailed from the very initial plan that has happened right from the beginning. So a client of hers was given a loan to purchase raw materials, which she was supposed to use for 8 months. But after the second visit, those stock levels had already been reduced drastically that it wouldn't last her for the entire loan period. And so this was a, you know, kind of an input problem. She's not going to be able to produce, you know, the final product that she's going to be able to do during that period of time, and potentially not pay, you know, pay the loan back. So if you start to see these flags, you know, what would you recommend, either within the loan monitoring or, you know, something more deeper in terms of restructuring as well?
Oh, that's a tough situation. I've been there, and that is the most painful thing to go see, that a client is not going to finish the project based on what the funds you've given them. You know, one thing I try to find out right away is, did they not, you know, what caused this problem? Did they not project correctly how much, or did they not know financially how much this project was going to cost? Was it actually going to cost more? Then, you know, shame on them, and maybe a little bit of shame on the loan officer not realizing it was going to cost more. Or 2, were the funds misdirected to another place? Or 3, did something happen? Did something happen that made it so, like, they were going to renovate something and they tore down a wall and realized, oh my God, we got to rebuild this entire wall, it's an extra money. You know, if there's a reason, you can consider actually trying to give them maybe an interest-only period to, you know, something to help them get through those months to be able to have the money to do the project. But if they misdirected funds to something else, then you can't be nice. They were not of good character. So you got to find out, was it a character issue, or is it that they didn't plan, they didn't understand, and maybe a management issue? And then you can make your decision if you need to move forward and be hard on them, or if you can work with them. Again, I have a real problem with clients that, you know, okay, you give them some money, maybe 10% doesn't actually go to where it's supposed to go, but, you know, a significant amount means if it goes somewhere to a use that we did not approve as a financial institution, that says something about their character. And I don't want to give that person more money. It's a tough situation. Been there. Oh.
Great. Thanks so much. We have time for probably 1 or 2 more questions, and we have an institution that works in East Africa, and they're working more specifically with the financial institutions in terms of institutions that are upscaling from microfinance to SME lending. So what are some differences that need to take place, you know, as opposed to microfinance loan monitoring for SME loans, so they're not sort of suffering, you know, SMEs for portfolio problems as they're moving away from these micro loans into the small loans?
Wait, can you, sorry, can you say it?
Sure.
Wait,
So what
yeah.
would be some of the processes, the policies that need to change from microloans up to
Yeah.
small loans?
Oh, yeah. Okay, good question. Good question. That's very interesting. Yeah, a lot. I've done this, and so I'm just laughing because it's, unfortunately, some institutions I've worked with, and actually I've gone in to help them after they kind of just took the same policies, procedures, and the same loan officers and just moved them up into a bigger loan size and realized, microloans really are a mixture of family and business. Small SME lending should be where the financials of the business stand alone, and it's very separate. Of course, we do have that interlap between where some small loans maybe haven't include like families, more family-owned businesses. But so there needs to be more of a financial analysis, a retraining of the loan officer, and and also more monitoring. Bigger risk to an institution when you have these larger loans, right? So there should be more monitoring and watching over these clients. And a new template. Really, I have two types. I mean, I have my microcredit underwriting template I think I like to use in the institution. I have my small lending tablet, which is like, we look at installment payment in micro, and in small business lending, SME lending, we should have a debt service coverage. We should do a digger deep into financial statements. I mean, and small, if we give them a larger loan, they should be more sophisticated. They should understand finances a little bit more, as they get. So that's a few things I will say on that topic.
Great. Well, Donna, thank you so much. We do have one or two more comments coming in, but we have run out of time. And so for some of these extra questions, we'll post these on our LinkedIn group under CapPlus Exchange. So please link up with me, Jessica Alfaro, on LinkedIn, and also join our LinkedIn group, CapPlus Exchange, and we can answer some of your questions there. We'd like to thank Donna so much for a very, very interesting session, and thanks to all of our participants for all the great questions and discussion as well.